If you want to invest in the US stock market and get diversified exposure, S&P 500 index funds are a great option. These funds passively track the large cap stocks that represent about 80% of the total US equity market. Passive investing means no fund manager is actively choosing which stocks or investments to buy or sell. Instead, they just follow something called S&P 500 index, where you get a piece of share of all of these companies without having to pick up individual stocks yourself. Although there are many index funds that track the S&P 500, there are three options that stand out because of their ultra low expense ratios. This means more of your money stays invested in the fund, earning greater returns. Additionally, all these three funds have a historical performance that closely duplicates or even exceeds that of the benchmark index. Today, I will discuss some of the best options available in the market and the benefits they offer to the investors. I picked these funds based on a Morningstar report analysis and my own research looking at their individual websites. Remember, you only need to invest in one S&P 500 index fund. So there is no point of investing in multiple funds because they all give the same return. First in my list is the Fidelity's S&P 500 index fund. This fund has the lowest expense ratio on the list of all the popular ones, with only 0.015% as the expense ratio. And it also offers a competitive dividend yield. The Fidelity 500 Index Fund is an excellent option for investors looking for a single core holding. It doesn't have a minimum investment requirement for any account type, making it an excellent option for early stage investors. The only downside is its performance history is comparatively brief, and it's one of the newest funds. This may deter some investors who prefer funds with a longer track record. Moving on to the next one, which is the Charles Schwab 500 Index Fund. This has a slightly higher expense ratio than Fidelity offering, but it comes with the great benefits of more than 2 decades of performance history. And it's a big plus for investors who are willing to pay a bit more for a fund with a longer track record. It also gives a nice dividend yield. Just like the previous one, this fund has no minimum investment requirement. This makes it an excellent option for earlier stage investors looking to access large cap holdings without the stress of choosing individual stocks. Lastly, we have Vanguard's S&P 500 Index Fund, one of the biggest names in the industry. It has historically outperformed the benchmark index and has an extremely low expense ratio. However, this fund does have a 3,000 minimum investment requirement, which could be steep for some investors, even when investing with individual retirement accounts like IRAs. Overall, these S&P 500 index funds offer investors an excellent opportunity to get diversified exposure to the heart of the US stock market, and each has its unique benefits that cater to different types of investors. Here is a quick comparison of these index funds in a tabular form. You'll notice that Vanguard has a minimum investment of $3,000, but you also can invest in Vanguard's counterpart S&P 500 ETF, VOO, which has no minimum investment requirement. So which S&P 500 index fund is right for you? When choosing S&P 500 index funds, there are few things to consider. First, look at the expense ratio, which is the fee you pay for the fund's upkeep. As index funds are managed passively, you want a fund with a lower expense ratio. Also, consider the minimum investment required for the fund and if it fits your budget. The dividend yield is another factor to compare between funds, as it can boost returns. The fund's inception date is another important criteria if you prefer a solid track record for the fund before investing. I've read many personal finance best-selling books and keep reading online blogs on investing, and all of these authors prefer passive investing over active investing in the current age. Most active investors can't consistently beat the market even if they try to do their best. In fact, the high fees you will end up paying to them compared to the index funds mitigate any extra money you'll make from them. Also, the process of investing should not be complicated. You shouldn't focus on timing the market and buying and selling to make short-term gains. Instead, keep your money invested in index funds to let it grow over time. By investing in an index fund, you're spreading your money around, so you're not putting all your eggs in one basket. That way, you're more likely to make money over time because you're invested in a diversified group of companies. Index funds let you put your money into many different companies. So if one company doesn't do well, you still have money in other companies to help make up for it. So take the emotions out of investing, invest in one of these index funds, and let compounding do its magic. You're so much more likely to become a millionaire this way than to do active trading. If you liked today's video, please give it a thumbs up, and I'll see you soon in my next video. Subscribe to my channel, Your Everyday Economics, for more such useful information. Take care. Bye.